The 2019 No Consent No Sale Bill broadly sought to reverse the position that the original lender could send on to his or her loan to an entity of its choosing without consultation or consent, explanation or justification. We made a submission on the bill and attended a sitting of this committee back in March 2019, but the bill didn't progress. The former governor of the central bank, Philip Lane, suggested that, given that the consumer protection framework is identical, whether a loan is held by a bank or a non-bank, the bill would not add any extra degree of regulatory protection for consumers. At the same time, it would severely damage resilience, since the transferability of loans is a central feature in a modern financial system. We don't agree with this. Brendan Burgess of Ask About Money recently pointed out that some 113,000 mortgage loans have been sold by the main banks to vulture funds in recent years, with the reassurance that such customers would not lose out by having their loans sold. He cited an example of the significant disparity between the variable interest rate currently charged by one fund and the far lower rate currently provided by the bank to whom it sold a significant portfolio of loans. We agree with his suggestion that the existing variable rate should travel with the loan. Such failure is indicative of a standard of consumer protection that is subservient to servicing the needs of the economy, the financial system and the institutions that serve it. The sale of loans, whether impaired or not, is now endemic in the financial system. Over the past decade, we've had 3 separate pieces of legislation further facilitating the growth of a loan sale and loan saling infrastructure. These are the Consumer Protection Regulation of Credit Servicing Acts 2015 and 2018 and the Consumer Protection Regulation of Retail Credit and Credit Servicing Firms Act of 2022. Each of these statutes ironically leads with the words consumer protection, when their primary purpose is to facilitate the development of a loan sale industry whilst maintaining minimum standards of protections for borrowers through regulation. The recent 2022 Act is a prime example, in our view, of our concerns. After years of allowing non-bank entities to provide subprime hire purchase finance agreement without any requirement to be authorised, these providers must now become authorised as retail credit firms regulated by the central bank. The legislation, however, allows that a hire purchase agreement offered by a retail credit firm may charge up to an astonishingly high rate of 23% APR for what are car finance agreements. In relation to the migration of housing loans to funds remains the fate of family home mortgages that have been in arrears over lengthy periods of time, many of which are now owned by funds. The most recent figures available from the central bank are set out in our statement, and I don't propose to read them. What is clear from these figures, however, though, is that the number of accounts in arrears have been decreasing, but only slowly. There was no significant reduction in arrears cases during COVID. The number in arrears at the end of Q3 2021 was 47,681, compared with 45,746 at Q3 2022. The proportion of loans owned by funds grows with each quarter, close to 56% at the last count. At the end of 2021, 21,234 accounts, which is 45% of the total in arrears, were deemed to be cooperating with their lender but having no restructure in place, which is an indication of financial incapacity rather than unwillingness to pay. Cost of living and interest spikes threaten an increase in new arrears cases. We recommended in Pillar to Post that the central bank would publish 2 separate figures, one for accounts that go into arrears in a given quarter and one for accounts that exit arrears in that quarter, but the central bank continued to publish a net figure only. The next table we have in our statement is in relation to loans in legal proceedings and the time since the first hearing. These figures show us that funds now own close to 7 in every 10 accounts that are in the repossession process. A substantial number of these cases have been in the legal process for a lengthy period of time. 80% of the 435 set of repossession proceedings said to have been resolved, that is concluded in 2021, did not result in a possession order being granted. The attrition, distress, cost and economic loss that results from lengthy repossession cases is both regrettable and unnecessary. In Pillar to Post, we propose a mortgage arrears review office to resolve long-term legacy mortgage arrears cases outside the court. We believe that the proposal we've made may possibly circumvent perceived constitutional difficulties and act as a carefully balanced and strictly proportionate intervention which has taken full account of the respective rights and obligations of both the lender and the borrower. Thus, we propose that the Review Office could act as an avenue of appeal or review for borrowers who are unhappy with their lender's handling of their case under the MARP of the Central Bank's Mortgage Arrears Code of Conduct. The Review Office could oversee efforts to resolve long-term arrears cases, working in conjunction with the borrower's advisors and the lender's staff and representatives. It could also have the power to grant leave to a lender to bring repossession proceedings in the courts against a borrower in arrears, but equally could refuse to grant such leave on the basis that the lender hadn't made insufficient efforts to resolve the case and avoid legal proceedings. An appeal would be available to the Circuit Court for the lender in that event. Where a personal insolvency arrangement proposal is made on behalf of the borrower in arrears and is rejected by the lender, the current right to seek a review in the Circuit Court under the Personal Insolvency Act could continue to apply. Thus, the integrity of the personal insolvency regime would remain unaffected. Some other recommendations from the final Pillar to Post are that we are critical of the slow progress being made with the Department of Justice review of the Personal Insolvency Act. We pinpoint that a significant number of older borrowers in particular are in long-term arrears, but their properties are also in positive equity, making it very difficult to obtain an insolvency arrangement without creditor consent. We also expressed concerns about the limitations of the 𝐬𝐻 scheme, and the final paper also contains a section on the mortgage to rent scheme, which is a valuable option in some cases, but still delivering quite low numbers. Loan sales are not entirely confined to buy-to-let and family home mortgages. Hire purchase agreements and credit card balances in particular have also been sold over the past decade. It is conceivable that the sale of impaired loans in the unsecured debt space will increase, with the consequences that may have for households in difficult financial circumstances. There is also a significant data deficit here. There's no such data published on unsecured creditor agreements in arrears. Without data, it is impossible to gauge the potential extent of the problem.